Alright, this is the first video in a series of videos where we're going to talk about how to account for pension plans. Here's an outline of what we'll be talking about, and again, we can't go over all of this in one video. So, a pension plan is an arrangement where the employer provides benefits to retired employees for services they provide in their working years. So you really have three parties. You have the corporation, the employer, you have the employees, the retired ones, and you also have the pension plan administrator. So the employer, gives the employees, usually contribute, but then the employer then contributes to a pension plan, which then gives out the benefit payments to the retired employees. Pension plans can be, contributory or non-contributory. For a non-contributory plan, that just means that the employer bears the entire cost of it. In other words, the employees don't contribute anything. That is less common. Contributory is more common. You typically are going to contribute some money, and the employer will match a certain percentage of that. And then, a pension plan could be qualified, meaning it has tax benefits. We're not going to cover that in much detail. But what you should understand, though, is that a pension fund should be a separate legal and accounting entity. And here, this data is a little outdated, but you just have some size of some of these pension funds for some corporations here as a percentage of their pre-tax income. You see for General Motors, their pension expense accounts for about 8% of their pre-tax income. But let's get into the meat of it. Pension plans are either defined contribution plans or defined benefit plans. And it's a very big difference, so we're going to talk about that. For a defined contribution, the contribution is defined. So there's a certain amount that the employer is going to contribute every year. There's no guarantee on what the benefits will be when you retire. So the risk is really borne by the employees. The benefits you're going to receive are based on the plan's value when you retire. Defined benefit plans, on the other hand, as the name sounds, the benefit is defined. It's in the contract. It says you will receive this amount of money every year in your retirement. But the contribution is going to vary for the employer. If the employer invests very poorly and the asset values start going down, they're going to have to contribute more soon to make up for that. So the risk is borne by the employer. So which one is better? Well, if you're an employee, clearly defined benefit is better. You don't bear the risk. Not coincidentally, these plans are less popular than they used to be. But they're still out there, and they are going to be the focus of what we're going to talk about. Actuaries are a big part of this. Actuaries are people that make predictions about mortality rates, employee turnover, future interest rates and earnings rates, when people are going to retire, what their future salaries will be at the time they retire, and any other factors. You have a lot of assumptions when you have a defined benefit plan to make sure that you're able to pay those retired employees. So again, the focus is then on defined benefit plans. The accounting for defined contribution plans is very easy. It's very straightforward. So the tricky thing about defined benefit plans is that the employer essentially has to make sure they have enough to pay. And so you're going to have to report a pension asset or a pension liability, depending on whether you currently have more assets than what your future obligations are going to be for these retirees, or you have fewer assets than what your liability is for these future retirees. If your assets are lower than what your liability is going to be, then you're going to have a pension liability, a net pension liability. So two big questions you got to think about. One, what is the pension obligation that the company should report on their financial statements? And two, what is my pension expense for the period? Two big questions we're trying to answer here. The first one, what's the liability going to be? The FASB considered three choices. They considered the vested benefit obligation, or VBO here. This would be benefits for vested employees only. Okay. So some employees have not worked there long enough to have vested in the retirement plan. They would not be included. And it's the present value of the expected cash flows of paying for them. They also considered the accumulated benefit obligation, or ABO. This includes benefits for non-vested employees at their current salaries. Okay. So let's make a note of the difference. Vested employees at current salaries. That's for VBO. For ABO, it also includes non-vested employees at current salaries. The FASB went conservative. They decided to go with the projected benefit obligation, or PBO. This includes benefits for vested and non-vested employees at future salaries. Okay, so they're going to go ahead and make some actuarial assumptions about what employees will be earning in the future. And just to be conservative, right? I mean, these first two really understate your liability. You're really assuming that employees' salaries are going to stay at their current levels. That's not realistic. People get raises. Okay. So that's what the FASB decided. We're going to calculate the benefits for all employees, whether vested or not, at the predicted future salaries. And that's going to be our measure of the obligation we're going to have. So on your balance sheet, if you're a public company, you got to recognize how over or underfunded your pension plan is. And if it's overfunded, you have a pension asset. If it's underfunded, you have a pension liability. So how do you do that? It's easy. You just take the difference between what is the fair value of the plan assets. So those plan assets are stocks and bonds, things you invest in. Take the fair value of that and compare it to the liability, the projected benefit obligation. Okay, now our pension expense every period is complicated. We're actually going to use a worksheet to solve this because it's pretty involved. And I think I'm going to make another video for that. So let's pause right here.